Hello, ladies and gentlemen. Sanford Khan here. Welcome to Rogue Economics, lesson number 13, entitled What You Need to Know About the Stock Market. I'm, you might say, a rogue economist, but really, in reality, I'm a economic speaker and author. I'm going to be talking about some tools that'll help you gauge the stock market and tell you whether the stock market's in the stratosphere or in outer space or where. There'll probably be three of them. And I'm going to go using Wall Street Journal right now. And there's some things that are really kind of scary about the stock market. I mean, really kind of scary. So let's get into it and not waste your time or my time. I'm going to be looking at the stock market, the close of trading Friday, April 9th. Although it really doesn't matter. The tools could be used anytime, but let's just go Friday, April 9th. I'm going to look at this Wall Street Journal I have here. This is a Thursday edition, April 8th. There's an article in here on margin debt. It's section B1. As of February, late February, the margin debt, this is money people borrowed to buy stocks, okay? It's $814 billion, a record. It's a 49% increase year over year from February of last year. Why is that important? Well, that's the fastest annual increase since 2007. What happened in 2008? Bust. The market, housing crash went down. We're in a housing bubble. Besides the stock market bubble, we're in a housing bubble too. You know what happened in 2008. Before that, investors' borrowings grew this rapidly from the dot-com bubble, which ended in 1999. That was another huge increase around into the 40s. You know what happened in the year 2000? The dot-com bubble went pop. The borrowings are insane. People are what do you call it? It's a mass frenzy feeding now in the stock market and probably housing too. Let's go on to something else. So keep this in mind, okay? $814 billion margin borrowing, 49% increase year after year, year over year. The most reliable indicator that Warren Buffett uses, it's called the Buffett indicator, named after you know who, Warren Buffett, of course. It's basically the total market capitalization of the stock market, U.S. stock market, to GDP. That's all it is. As of the close of trading today, Friday, April 9th, 2021, it stands at 201% of GDP. This is historic highs. Historic highs. This is higher than it was in the year 2000. It is way higher than it was in 2000, way higher than it was in 2007, both times when the market topped out. As far as back as 1975, it hasn't even come close to this. To say the stock market's in the stratosphere would be putting it mildly. It's in outer space. It's in outer space. It is a huge bubble, fueled by, what did I just read? Or read to you. Margin debt. 800 and, what was it? $14 billion of margin debt. Record. Okay. Let's move on to something else. The Buffett indicator is just beyond anything I've ever seen. That doesn't mean the market can't still go up. It can. It can still go up. Momentum is still to the upside. But it's giving you an indicator that, you know, things don't always go according to plan. There's actually more things could go wrong than could go right. By the way, that's called entropy. More things that could go wrong than could go right. Okay, the stock market is risky business. I think you will all agree with that, okay? So what's more risky? A 10-year treasury note or the stock market? 10-year treasury note could go down in value. If interest rates go up, the note goes down. If interest rates go down, the value of the note goes up. But it doesn't plummet. It could drift down or go back up. The stock market could plummet. You could have a big sell-off in one day and it plummets. But the treasury note doesn't do that. So you would think that the dividend yield on the S&P 500, I'm using the S&P 500 because it's much more accurate than the Dow Jones 30 Industrials. You'd think because the market is much more riskier than a 10-year Treasury note, the dividend yield on the S&P 500 should be higher, actually much higher than the yield on the 10-year Treasury note. And that's usually how it is. But to show you how wacky things are, that's not the case right now. It inverted. For instance, again, I go to my Wall Street Journal. This is Friday's edition of the Wall Street Journal. The dividend yield on the S&P 500 is now at 1.45%. 1.45%. Comes right here from the Wall Street Journal. Meanwhile, the yield on the 10-year Treasury note is at 1.67%. So the yield on the Treasury note is 22 basis points higher than the yield on the S&P 500, the dividend yield on the S&P 500. You would think it would be the opposite way around. It should be, but things are so crazy, it isn't. Like I said, the stock market could continue up, but if there's a sell-off with the amount of margin debt we have, the whole thing could cascade down because there'll be margin calls and people will have to be selling their stock to meet margin calls, and then it goes down more and more people have to sell to meet more margin calls. What do you think is going to happen? You could have a huge sharp sell-off real fast, and you should be aware of this. Meanwhile, the momentum is still up. Yes, it's still up. But beware of the dangers. They're out there right now. Anyways, I spoke long enough. Appreciate it if you could pass this video on to other people and hit that red button down below, and subscribe to my YouTube channel. Until we meet again, prosper, keep safe, and remember, liquidity is king. Take care now, folks. Bye.